Today we're tackling a big financial dilemma that many homeowners face, and one that I wrestled with recently. Should you aggressively pay down your mortgage, or should you be investing that extra cash in the stock market? It is a question with no single right answer, so it's good to be systematic about it, because what's best for your neighbor may be totally wrong for you. So we're going to break this down in this video. I've gone through the main considerations and questions you should ask yourself to help you make the smartest decision for your situation. So I've been thinking about this issue for some time. We have a mortgage on our main property that we live in, as well as a number of mortgages on investment properties that we own. I've been thinking about and working through as to whether it's better to pay off some of those mortgages or to continue to invest. To do that thinking, I asked myself a number of the questions below. So once we've been through all the considerations in this video, I'll tell you what I'm going to be doing. First of all, we need something to compare the cost of a mortgage against. So I'm using a broad global index fund like Vanguard FTSE All-World as our example investment. And we'll look at a typical UK mortgage rate tied to the Bank of England base rate. So grab a pen and paper, open your notes app, whatever you prefer, because we're going to go through a series of questions to help us get that clarity we need. So let's dive in. First up, let's get to the fundamentals. Let's look at the numbers. This is where we look at the cold, hard financials. The most crucial questions to ask is, what's your mortgage interest rate? You need to find out the effective rate. The effective rate means the rate you pay including fees. You can usually get this from your mortgage statement or from your lender's website. For the moment, let's say that it's 2% above the Bank of England base rate. So the base rate was 4.5%, so that makes the effective rate 6.5%. Now, what's a realistic return you can expect from the stock market? We're using the Vanguard FTSE All-World VWRP as an example. Historically, over the long term, global stock markets have averaged about 8 to 10% per year, sometimes a bit more. In recent years, the VWRP has done even better with about 11 to 12% annually, at least over the last 3 to 5 years. But of course, past performance does not guarantee future performance. So we'll use 8 to 10%. So if your mortgage rate is 6.5% and you expect an 8 to 10% from the stock market, on paper, that investment looks better, right? You're potentially earning more from the stock market than you are saving in interest. But here's the key: expected is not guaranteed. Mortgage payoff is a guaranteed return equal to the interest rate. Stock market returns are not guaranteed and come with risk. So next, ask yourself the following: how much risk can you afford to take? Think about your overall financial picture. Do you have other debts maybe, or do you have a solid emergency fund? What are your big financial goals in terms of retirement, early financial independence, any specific purchases you want to make? Also, if you're younger, have a longer time horizon and a stable income, you might have a higher risk capacity. If you're closer to retirement or more risk averse by nature, you might prefer the safety of mortgage payoff. Crucially, the question to ask is, what happens if your investments go down? Could you stomach a market downturn? Would it derail your financial plans? And finally, in this section, what's your investment time horizon? Investing in the stock market is generally a longer term game, 10 years or more. The longer your time horizon, the more time your investments have to potentially grow with compound interest, and you can ride out the market's ups and downs. But if you need the money in a few years, the stock market might be too risky. Mortgage payoff provides a more immediate and certain financial benefit. Now let's get a little bit more personal. Finance isn't just about the numbers, it's about you. These psychological questions that we're just about to go through are really important. So we touched on risk capacity, but risk tolerance is about your comfort level with the risk. Even if you can afford to take the risk, do you want to? So you can imagine checking your investment account and seeing it's down 20%. Would you panic? Would you sell at the bottom? Or would you see it as a long-term opportunity? You've got to be honest with yourself. If market volatility keeps you up at night, mortgage payoff might be less of a stressful path. And this leads us on to, how much do you value being debt-free? For some, the psychological relief of paying off their mortgage, it's priceless. It frees up cash flow, reduces stress, and provides that sense of security. If you're naturally debt averse, that peace of mind might outweigh any potential higher return in the stock market. So let's dig a little bit deeper and consider a couple more financial angles. Let's consider opportunity cost. What else could you do with the money? If you pay off your mortgage, that's it, the money's gone. Could that money be better used for something else? Building an emergency fund, starting a business, investing in your own education, or even just enjoying life a bit. So consider the opportunity costs. What are you giving up by choosing one path over another. Finally, let's take a brief look at how taxes might impact your decision in the UK. So part of the equation you need to think about, will your investments be tax efficient? And does that make a difference to the returns you might expect? As we know, in the UK, we have ISAs, individual savings accounts. They're tax efficient wrappers for your investments. A stocks and shares ISA shelters your investment growth from both income tax and capital gains tax. So are you fully utilizing your annual ISA allowance? If not, investing through an ISA becomes even more attractive. Also, investing in pensions comes with tax relief benefits, which are hard to beat. However, if you choose to invest in taxable accounts like a general investment account, then you'll need to consider the tax you'll need to pay on the proceeds, both the dividends, but also the tax on the gains you make. Okay, why don't we bring this to life with some examples? Firstly, we've got a long-term investor. We're going to meet Sarah. She's 35. She's in a stable job. She has a 25-year mortgage at 6.5%. She's got a good emergency fund and is investing for retirement in 30 years. So let's run through our questions for Sarah. Like I said, she has a mortgage rate of 6.5 with an expected return of 8 to 10%. When it comes to risk capacity, her risk capacity is high. She's a long-term investor and she has a stable income. Her time horizon is long, 30 years to retirement. Her risk tolerance is medium to high. She understands that market fluctuations happen and are normal over a long investing period. In terms of peace of mind, she values financial growth more than immediate debt reduction. And when it comes to opportunity costs, she wants to maximize her long-term wealth building so that she's prepared to invest in that. In terms of taxation, she utilizes her stocks and share ISA allowance. So what's the verdict for our example, Sarah? She's likely better off investing. For Sarah, with her long time horizon, a high risk capacity and tolerance, and a focus on long-term growth, she is probably best investing in something like a globally diversified fund in her ISA, and that will probably make her financially better off in the long term. Now let's take a look at our next example. We're going to meet David. He's 55. He's closer to retirement. He also has a 6.5% mortgage. He's naturally quite risk averse and values security. If we go through the same questions with David, he has the same mortgage rate, 6.5%, with expected returns of 8 to 10%. Risk capacity wise, it's much lower. He's closer to retirement. There's less time for him to recover from losses. Therefore, his time horizon is shorter, 10 to 15 years to retirement. His risk tolerance is low. He prefers certainty and avoids market volatility wherever he can. Leads after peace of mind. He sees value in being mortgage free before his retirement. He worries less about opportunity costs. He's less concerned about maximizing returns and prioritizes security. From a taxation perspective, even though he knows that an ISA is helpful, the peace of mind on paying off his mortgage is paramount. So the verdict for David, it's likely that he's better off paying off his mortgage. That guaranteed return of 6.5% by paying off the mortgage, combined with that immense peace of mind, it outweighs the potential but uncertain returns he might get from the stock market. Now we're going to look at a fence sitter. Could go either way. We're going to meet Maria. She's 40, she's mid-career, she has again a 6.5% mortgage rate and a moderate risk tolerance. She's saving for retirement but also has other medium-term goals. And for Maria, her mortgage rate, as I said, 6.5% against an 8 to 10% return. Her risk capacity is medium. She's comfortable with some risk, but she's certainly not reckless. Her time horizon is medium, 10, 25 years to retirement, and her risk tolerance, you consider it moderate. Wants growth, but also some security. From a peace of mind perspective, she certainly values debt reduction, but also wants to build on her wealth. And from an opportunity cost, she wants to balance debt reduction with investment growth. From a taxation perspective, she's going to use her ISA allowance if she chooses to invest. And the verdict for Maria, it depends really. Maria is truly in the middle. She could realistically go either way. She might choose to split the difference, put half towards her mortgage and half towards investments. Or she might lean slightly towards investing but make extra mortgage payments when she feels that she can. For Maria, it's more about finding a balance that feels right for her comfort levels and evolving priorities. So what about for me? Okay, well, let's go through the questions. I have a mortgage rate of 5% versus that expected 8 to 10% return. My risk capacity is high. I'm comfortable with the risk over the long term as I've got cash buffer through other investments with low volatility that would cover market dips. My time horizon is medium, 12 years. My risk tolerance is moderate. I want growth, but also some security. But this is gained through other assets in my portfolio, not by paying off the mortgage. Peace of mind, yes, I do value debt reduction and wealth preservation, but building wealth continues to be important, and it's an important goal for the next 12 years. There are no opportunity costs, there's no competition for this money with other investment goals. And taxation wise, I will utilize ISA allowance, pension allowances, and general investment accounts. So when I go through these questions, I can see that it's likely that I'm going to continue investing over the next 12 years. That's my time horizon. It's probably a better outcome in terms of long-term results, and I'm comfortable with the risks of the market, and so I'll stay invested largely in diversified global funds. However, what I have done more recently is switch some of my mortgage to a better deal, meaning lower interest rates, so that equation looks better. And I expect in about 12 years my circumstances will have changed enough that I may choose to pay down some of those mortgages. So as you can see, there's no real magic formula for this. The best decision for you depends on your individual circumstances, your financial goals, your risk tolerance, and your personality. So why not go through the questions, answer them as honestly as you can, run your own numbers, consider the different scenarios, and probably most importantly, have a think about what will help you sleep most soundly at night. So let's wrap up. Let me know in the comments which of the examples you most identify with. Are you leaning more towards paying off your mortgage or investing? And if you found this video useful, please give it a thumbs up, subscribe, and click on the notification bell to be advised of future videos. And please share this video with anyone you think might gain value from it. And with that said, thanks for watching.